Hello, I'm Tom Nash, real estate lawyer at Mills Reeve, and I'm joined today by Tom Fraser, Director and Head of Office at Savills. And we're here to talk about patient capital investment in real estate. So, Tom, what is it that we mean by patient capital in a real estate setting?
Thanks, Tom. From my point of view, in relation to the delivery of residential land and particularly strategic land, we view patient capital as the overarching aim to achieve higher returns over the medium to long term rather than the short term.
Okay, and what kind of investors do you typically see looking to invest in patient capital?
So there are various different investors out there, and their appetite for risk and return varies. And quite often we will see investors acquiring land quite early on in the planning stage, or potentially partnering up with a house builder when it comes to the delivery, due to the significant infrastructure costs, Section 106, and just abnormal costs to help with delivery. But where we seem to see the principle of patient capital more and more is actually on the landowner side, whereas traditionally landowners may choose to achieve a planning permission through whichever route, be it development partner or be it themselves. There has been a move, and I'll come on to what the different circumstances are, away from a straight sale. And for some of the longer term estates, if I could put it like that, there is an appetite for longer term participation with the development of land, with the shared risk and rewards that comes with that.
So, Tom, are there any particular trends that you're seeing in patient capital investment in real estate at the moment?
So from a landowner perspective, there are three key areas which we tend to come up against. The first is tax. Clearly, how the land is held is really important, because if it is held personally, then income tax is going to be due, where if it's held, for instance, in a farming company, or if it's held corporately, it's a different tax structure, which is much lower. We did think at one point that that tax rates would be aligned, therefore the ability for a landowner to participate would become much more attractive because of the unnecessarily high level of tax. But that hasn't happened. It may do, but we'll have to see what happens in the budget in months to come. The other two aspects that I just wanted to pick up on in terms of patient capital from a landowner's perspective is we have been involved with various joint ventures, build licenses, build leases, and this often comes down to the landowner's appetite to participate. And when I say participate, some of the longer term estates have a particular eye on delivering high quality design, placemaking, legacy, and the different models allow them to try and capture that and gives them the necessary control rather than just a straight sale. And then, of course, there is the sharing of the risk and return. Whilst the returns could be higher over time, the risks are equally higher. Now, we are in the Eastern region forecasting house price inflation at about 17% over the next 5 years. You then have to think about what's going to happen to build costs, infrastructure costs, and whether there will be a point where HPI will be higher than total costs, which in time would make it more attractive. But actually, a lot of the estates have taken the view that if they get the right development partner, if they get the right mix of quality legacy, and they use the principles of placemaking, that in time they can deliver a better product, a better return for the estate, and, as I said, participate in a positive way for the short, medium and long term.
Thanks, Tom. That's really interesting. If anyone would like to know anything more about patient capital investment in real estate, do get in touch with either Tom or I, or check out the Mills Reeve Patient Capital Investment website. Thank you very much.
Thank you.